Welcome back to Investing Talk Podcast.
Today we're looking at Battalion Oil.
As usual, before we start, subscribe, like, and comment to this video to support the show. And let's just jump right into things today because, well, what we're unpacking is the kind of market event that absolutely demands your attention.
Yeah, it really is.
I mean, we are talking about a stock that experienced a near 100% surge in a single trading day. Just think about that for a second. You know, you wake up, you check your portfolio, and a position has effectively doubled while you're just pouring your morning coffee.
It's the kind of explosive price action that immediately sets off alarm bells across the market, right?
Exactly.
Because when you see momentum at that scale, the absolute first question you have to ask yourself is, what is actually happening under the hood? Like, is this just a flash in the pan, or is there a structural reason for it?
Right, and that's our mission today. We're going to strip away all the market noise, cut through the panic buying, and look directly at the engine of this company. We really need to figure out exactly why Battalion Oil is seeing this massive momentum and, more importantly, give you actionable insights, not just, a recap of a wild day on the ticker.
Because it is incredibly easy to get swept up in the emotion of a massive green candle on a chart.
Oh, absolutely.
But the market is a weighing machine in the long run. You have to look at what is fundamentally driving the capital allocation.
So let's dig into the fundamentals, because right out of the gate, we're hit with this fascinating contradiction. When you look at the revenue trajectory over the past year, it's impressively stable. I mean, we're talking about consistently hovering right around that $50 million mark per quarter.
Yeah, they've been delivering on the top line like clockwork. Look at their performance through 2024. In the first quarter, they brought in just under $50 million, which was a solid 3.59% beat on Wall Street's expectations.
Right.
Second quarter, roughly the same revenue, $49.1 million. Another solid beat, 3.41%.
Okay, so consistent beats.
Yeah, they had a slight dip in the third quarter, a minor miss, but then they finished the year remarkably strong. The fourth quarter of 2024 came in at 49.65 million. That beat estimates of 47.54 million by over 4.4%.
Okay, beating estimates almost across the board sounds fantastic.
Wow.
But I have to play the skeptic here because there is a glaring red flag waving on the field.
Let me guess, the EPS.
Yes, the earnings per share, or EPS, is starkly negative. In that strong fourth quarter we just talked about, the EPS came in at negative $1.88.
Yeah, that's a big miss.
It's massive. Wall Street was forecasting a positive 5 cents. And the previous quarter, it was a similar story. So how do you reconcile a company that consistently beats revenue estimates, but just violently misses the bottom line earnings?
To understand that disconnect, you really have to look at their efficiency mode and how they are managing their cash flow. What stands out in the data is their gross margin. They are operating with incredible 100% gross margins.
Wait, hold on.
Yeah.
A 100% gross margin in a physical, capital-intensive industry like oil drilling. Pulling resources out of the ground usually costs a massive amount of money right off the top. Explain to the listener how that's even physically possible.
Right, so think of it like running a highly specialized bakery. Normally, your gross margin is what's left after you pay for your flour, sugar, and the baker's hourly wage.
Right, the basic overhead.
Exactly. But what if you structured your business so that those direct daily baking costs, what the oil industry calls lifting costs, were somehow perfectly offset by the way you account for your massive ovens and delivery trucks over time?
Oh, interesting.
Battalion Oil has structured its accounting and core lifting costs versus its broader operating expenses in a way that makes their direct production efficiencies look absolutely best in class.
So they aren't getting the oil for free.
No, definitely not.
But they've built a system where their direct cost of pulling the next barrel out of the ground is staggeringly low compared to the revenue it generates.
Precisely. They've built a competitive moat around high-quality oil plays and innovative automated drilling technologies. This drastically lowers their break-even costs compared to their older, heavier peers.
Got it.
But going back to your question about the negative EPS, you have to look at what they're actually doing with the money they make. Let's look at the cash.
Okay, let's open up the balance sheet. Because they're sitting on about $50.5 million in cash reserves against total assets of nearly $500 million. $491.69 million to be exact.
And here is where the EPS contradiction finally starts to make sense. They are generating a very strong operating cash flow, almost $28 million.
27.9 is 7 million now.
Right. But they have net investing cash outflows of over 16.49 million. What does this tell us? It tells us they are taking their free cash flow and aggressively sinking it back into the business.
So they aren't hoarding cash in a vault somewhere.
No.
And they certainly aren't paying it out to shareholders.
Exactly. No dividends, no major share buybacks right now. They are funneling every spare dollar into asset optimization and upgrading their drilling technology.
Making the machine better.
Yeah. They are intentionally eating the short-term earnings hits, which shows up as that deeply negative EPS, to build a long-term, highly efficient production machine.
So the core operation is healthy and generating cash. They're just sacrificing the quarterly beauty contest of positive earnings to build a much cheaper, more efficient drilling operation for the future. That makes sense.
It does.
But it definitely requires a lot of patience from anyone holding the stock.
It does require patience, but it's a brilliant defensive strategy. By lowering those break-even costs, they can survive and even thrive when global oil prices get volatile.
Right, because some of the more bloated companies need oil at record highs just to break even.
Exactly, and Battalion Oil doesn't.
Well, someone out there clearly lost their patience and decided to buy everything in sight. Because let's pivot to the charts. The recent price action is nothing short of explosive.
Yeah, it really is.
The market is suddenly waking up to whatever Battalion is building. I want to unpack this timeline for you because it defies normal market logic.
It's a textbook volatility expansion, and it happened incredibly fast.
On February 27th, 2026, the stock jumped over 40%, 40.52% to be exact.
Which is huge.
For most companies, a 40% gain is the best single day of the decade. People throw parties for a 40% gain.
Right.
But Battalion Oil was apparently just stretching its legs. A few days later, on March 2nd, 2026, the stock surged an absolutely staggering 99.64%. It effectively doubled in a single trading session.
And if we look closer at the intraday flow, the story gets even more interesting.
Oh, the pre-market data.
Yes. During the pre-market session on that massive day, before the opening bell even rang, the stock hit $8.88 a share. And it did that with $19.26 million in turnover.
While most people were still asleep.
Exactly.
Let's pause there, because $19 million in turnover before 9:30 in the morning is an insane number for a company of this size. What we're seeing here is a massive psychological shift. Think about the journey this stock has been on.
Yeah, it's been wild.
It was sitting at a 52-week low of just $1 single. Now, with this momentum, it is showing clear breakout behavior, charging straight toward its 52-week high of $13.61.
Yep.
When a stock goes from $1 to nearly $9 pre-market and moves $19 million in the dark hours of the morning, are we sure this isn't just a massive wave of retail day traders jumping on a meme stock?
The data strongly suggests otherwise. Retail traders generally don't have the coordinated capital to move over $19 million in pre-market illiquidity. The volume was several-fold higher than usual.
Right.
When you see volume multiples at that scale, coupled with massive overnight gap-ups, that is the unmistakable footprint of institutional flow.
So pension funds, hedge funds, the big Wall Street players.
Big money is aggressively stepping in. We are in a distinctly risk-on environment for the energy sector right now, and the larger funds are reallocating capital. They see the volatility expansion, they see the breakout momentum, and they are piling in.
So if institutional money is pouring in and the stock is literally doubling in a day, the financial news networks must be screaming about this nonstop.
Right. You would think so.
Well, this is where the data gets genuinely weird. Let's pivot to market sentiment. Because when you look at the quantitative sentiment scoring across the media landscape, we have a bizarre contradiction.
It is completely counterintuitive to the price action.
The sentiment score is a flat 0, neutral. The top 5 recent market stories circulating right now carry a completely neutral score. How does a microcap stock double in a single day, and the algorithmic sentiment scrapers basically just shrug their shoulders?
What you are seeing there is a fascinating quirk of how the broader financial media operates during major global events. The algorithms aren't picking up stories about Battalion Oil's specific business model because the headlines driving the sector aren't actually about them.
Right.
The top stories are focusing on general session movers and the broader oil and gas sector lifting due to massive macro and geopolitical tailwinds. The news is reporting on the whole ocean rising, not the specific boat.
And they report macro news in a very clinical, factual way, hence the neutral score.
Exactly.
Let's talk about those geopolitical tailwinds,
Yeah.
because they are the elephant in the room driving that ocean. And for you listening, we're looking at this strictly from a factual market mechanics perspective without taking any political sides.
Yes.
Recently, there have been significant geopolitical catalysts, specifically the U.S. and Israel's strikes on Iran.
Right, and alongside that escalating situation, you have mounting very real fears regarding the potential closing of the Strait of Hormuz.
Right. And just to provide context purely on the economics here, the Strait of Hormuz is one of the world's most critical choke points for global oil supply. A massive percentage of the world's crude passes through that narrow waterway.
It's vital.
Whenever there is tension in the Middle East that threatens that specific area, the global market instantly prices in the risk of severe supply disruptions. And when supply is threatened, the price of the commodity skyrockets.
It is a pure supply and demand calculation by the algorithms and the commodity traders. These escalating tensions are driving up the entire broader oil and gas sector.
And that drags Battalion oil up with it.
Exactly. Connect that back to the company. They are catching a massive draft from this macro environment. Because their operations and assets are domestic, situated safely within the United States, they become increasingly valuable when international supply lines are threatened.
Their oil doesn't have to travel through a conflict zone to get to market.
Precisely.
But it's not just the macro news driving this institutional buying, is it? There is a very loud rumor mill churning in the background that we need to address. This is the speculative side of the catalyst coin.
It is completely unconfirmed, but the chatter on the street is heavily focused on strategic acquisitions and new sustainability initiatives.
The whisper is that Battalion Oil is positioning itself to be bought. And when you piece the puzzle together, a company with 100% gross margins, a tiny valuation, heavily reinvesting its cash into elite tech and optimizing its physical assets, it paints a very specific picture for the larger market.
It paints the picture of a prime M&A target. The oil sector is going through a rapid period of consolidation right now.
Yeah, we've seen a lot of buyouts lately.
The massive legacy players are flush with cash, and honestly, it is often much cheaper and faster for them to just buy a highly efficient, technologically advanced, smaller operator than it is to build those efficiencies and permit new wells themselves.
That makes total sense.
Battalion Oil's recent strategic moves make them incredibly appealing for a buyout. They have done all the hard work.
But here is the catch, and it's a big one. Despite the 99% surge, despite the obvious institutional volume, and despite all these M&A rumors, there are notably no 2025 or beyond analyst upgrades yet. The big institutional analysts haven't officially revised their long-term targets upward. It makes you wonder, is Wall Street just incredibly slow to catch up to what is happening here?
It is a classic scenario where price action front runs the analyst desks. The market, the actual buyers and sellers, prices in the potential long before the official reports are written, edited, and rubber-stamped by the big banks. The money moves first, the paperwork catches up later.
Okay, time for a reality check. Let's look at the bear case. We cannot talk about a stock that goes up 100% in a day without talking about the very real risks of it coming right back down.
Absolutely.
First and foremost, you have to understand the microcap risks involved here.
This is crucial context for anyone looking at this data.
Battalion Oil has a market cap of just $194.19 million. In the grand scheme of the public markets, that is a drop in the bucket. And with a market cap that small, the float, which is the actual number of shares available to trade on the open market, is very restricted.
Which inherently creates massive, sometimes violent volatility.
Exactly. It goes up nearly 100% in a day, sure, but it can absolutely drop 50% in a day just as easily if the wind changes.
The liquidity at that size means that any single significant institutional buyer or seller will move the price dramatically. You have to have the stomach for that kind of turbulence. It is not a set-it-and-forget-it index fund.
No, it's not. We also have to hammer home the profitability pressures. We touched on it earlier, but that persistent negative EPS and those negative pre-tax margins act as a heavy anchor.
Yeah.
They are carrying existing debt. Yes, they're reinvesting heavily, but they are doing it in a very capital-intensive industry while having to service that debt. If their fancy new technology upgrades don't yield the production results they are forecasting, that debt burden becomes a massive existential problem very quickly.
That is the tightrope management is walking right now. They are betting that their operational cash flow will continue to support this aggressive expansion. But if the broader macroeconomic environment shifts, that bet gets significantly riskier.
Which brings us to perhaps the biggest risk of all, geopolitical dependency. We just spent time explaining how the Middle East tensions and the Strait of Hormuz fears are lifting the entire sector. What happens if those tensions actually cool down tomorrow?
That's the million-dollar question.
What if a diplomatic resolution is reached, the supply fears evaporate, and the global price of crude oil drops sharply? Does Battalion Oil's stock price just completely collapse because the macro helium has been let out of the balloon?
That is the ultimate risk factor here. If the macro oil lifts disappear, the stock will undeniably face downward pressure. The whole sector would reprice.
Right.
However, you do have to weigh that against their internal efficiency moat. Because they have driven their break-even costs down so incredibly low with their technology, they can survive a drop in oil prices much better than many of their competitors.
Because of that 100% gross margin on lifting costs.
Exactly. They don't need crude oil to be at record highs to maintain operational stability. But you are absolutely right. The current explosive stock momentum is heavily reliant on those global supply fears. It's a risk that has to be fully respected.
So taking all of this in, we've looked at the steady revenue beats, the intentionally ugly EPS, the incredible pre-market price action, the geopolitical tailwinds, and the very real micro-cap risks. So what's the final verdict?
Based on the quantitative data, the structural setup, and the massive disconnect in valuation, the final thesis yields an 8 out of 10 bullish score.
An 8 out of 10, that's highly convicted. Give us the elevator pitch. Summarize the core thesis for the listener. Why is this an 8?
It comes down to a fundamental disconnect between the company's operational reality and its current valuation. You have a company operating with those elite 100% gross margins, generating roughly $28 million in strong operating cash flow, and aggressively reinvesting that cash into massive production efficiencies. But the real kicker is the valuation gap. They have physical, proven assets on the books worth nearly $500 million, $491 million to be exact.
Yeah.
Yet their entire market cap is sitting at just over $194 million. They are severely undervalued relative to the actual physical assets they hold.
And that severe undervaluation acts like a coiled spring, which is exactly the kinetic energy we saw snapping over the last 2 trading sessions. So how should a listener look at playing this data? What is the target horizon?
The structural data clearly defines this play as a swing trade into earnings. The timeline you need to be focusing on is the next few weeks.
Mark your calendars right now, folks. March 26, 2026.
That upcoming earnings report is the major near-term catalyst. That is the moment of truth for the company.
The moment they have to show their cards.
Exactly. That is when management will have to prove that all these heavy capital expenditures and efficiency gains are actually going to inflect the earnings positively, just as the consensus expectations are forecasting. If they show that turnaround in the EPS, this recent momentum will be fully validated by the fundamentals.
I want to leave you with a final provocative thought to mull over as you watch this ticker. We are watching an escalating global energy crisis unfold in real time, which is driving the value of secure domestic oil production through the roof. At the exact same time, we have this intense, unconfirmed chatter about strategic acquisitions buzzing around a company that is demonstrably undervalued compared to its physical assets.
It's quite the setup.
You really have to ask yourself, with all of this institutional money suddenly flooding in before the sun even comes up, and a near 100% surge in a single day, is Battalion Oil just experiencing a lucky macroeconomic bounce? Or is this just the very beginning of a much larger, very lucrative buyout story? Keep a close eye on this one because the next few weeks are going to be critical. As usual, before we sign off, subscribe, like, and comment to this video to support the show. We will see you next time.